What is going on, guys? What is going on? Good to see everybody. Whoa. Good morning. Good morning. Good afternoon, depending on where you are. So this is a private link. Actually, give me 1 second, real quick. Give me one flaming hot second, real quick. One second. I just need to make an announcement to make sure that all the latecomers and lazy people know that I'm going live. All right. So I wanted to do this training for a couple of reasons. One, because am I all good with the mic? Yes. One, because I think it's important going into 2026. I don't think the market is going to be on easy mode anymore, right? I think that we are entering the fourth year of a bull market. We are obviously in a bubble. And I don't think that there is enough education out there, and certainly not enough free education out there as it relates to things that people want to do in the market, right? Options trading, futures trading. So being in the position that I'm in, I obviously get asked a ton of questions about certain plays. And just based on the questions, it's insane the lack of knowledge, basic knowledge. And I think some of that comes from the lack of good information out there, right? So I wanted to demystify some of this stuff because it is hard. Again, we're not talking about investing here. We're talking about swing trading and day trading. So I get questions all the time. Should I buy calls for next week? Should I buy calls on United Healthcare? Should I buy the 400 calls? Or even worse, when they already bought the calls and they don't know what to do with it, right? I bought calls on NVO and they expire on Friday. What should I do? They're down 85%. It's obvious that there is a lack of good information out there. So I think that you will learn a ton about options trading and about swing trading in general. Now, today we're going to be focusing on option swing trading. Tomorrow we're going to be focusing on day trading and then dive into futures as well, because there's a stark difference between the risk management and between the risk proposition of futures versus options, right? So in this, we will be focusing on option swing trading. Now, the charting aspect of this will also apply to stocks, right? So even if you're not planning on trading options, or you haven't gotten into trading options, or you're not there yet, but you're thinking about it, the technical analysis portion of swing trading will also apply to stocks. But remember, this is not an investing mastermind, right? This is not an investing accelerator. Investing is something completely different and really doesn't require as much thought. I think people overcomplicate investing. That's another story for another day. So let's talk about, let's get into the option swing trading accelerator. So an introduction to options. What this is not going to be is I'm not going to be breaking down the very basics of options. Coming into this, I assume that you guys know the basics, but just to give you a refresher in case you don't, again, this is not going to be an introduction to options from starting from zero. I'm assuming that you know something about options here, right? We want to focus more on the swing trading aspect of it. I don't want to focus on what is an option and dive into a half an hour discussion of what that is. But options are contracts they're derivatives. They're contracts based on the underlying component. The underlying component is the stock. So almost every single stock has an options chain. Now, some are more liquid than others, and we will talk about why you want to stick to liquid options. But you have two different types of options. You have calls and puts. And in general, calls, if you're buying them, calls means that you want the price to go up. And if you're buying puts, you want the price to go down. That's simply it. They are contracts that give you the right to either buy 100 shares of the underlying or the right to sell 100 shares of the underlying. A lot of people think that they are bets. They're not bets. They are actual derivatives. They are assets. They have value. But the way that people trade them, especially most noobs, they treat it like a sports bet, or even worse, they treat it like a bet in Vegas, right? They're not bets. You are buying actual contracts, and those contracts have value, right? Now, options, the difference between options and stock trading is the options contract itself has a time value, meaning it has an expiration. So if I buy a share of what chart am I on? If I buy a share of Tesla, right? That it doesn't have an expiration. I could just buy a share and sit on it for 100 years, insofar as the company exists in 100 years. But it doesn't have an expiration. Options have expirations. They are time-based instruments, right? So that is the main difference between options and stocks. You are not buying the stock itself. You are buying a derivative of that stock that has an expiration, okay? Pros and cons of trading options. Pros, more leverage. So, for instance, if I buy a share of Tesla and Tesla goes from 430 to 435 and I spent $430 on that share, I made $5 on that, right? Whereas if I'm trading options, because it is a leveraged instrument, right? It represents 100 shares of Tesla, and we're going to go into how to calculate or estimate how much money you will make or lose in an option. But because I'm buying an underlying, because I'm buying a derivative of an underlying, right? And that derivative represents 100 shares of that underlying, that automatically infuses it with leverage. So if Tesla goes from 430 to 435, I'm making way more than $5, right? Now, how much I'll make depends on the expiration, the strike price, which then determine also the Greeks, which we will talk about, right? So more leverage, cheaper. If I look at a share of Tesla right now, it's $430, right? If I go to an options chain, and let's say that I pick the monthly expiration, and I look at the 430 strike, it's currently almost $1,900, right? But this represents 100 shares. If I were to buy 100 shares of Tesla, that would be $43,000 versus $1,900. So I'm getting exposed to 100 shares of Tesla with one options contract, as opposed to having to buy 100 shares. Now, I personally know some really great traders who trade stocks and don't trade options. They have a ton of money, right? You need a large account to be able to trade shares. I'm not opposed to it. But the pro with options is that you have leverage. So it allows you to make money with a much cheaper capital investment. So obviously it's cheaper. And then the ability to create complex strategies. So we're not going to get into this a whole lot for this accelerator, but one of the things you can do, for instance, is buy call spreads or sell call spreads, or buy put spreads and sell put spreads, right? You can use options to get creative. So for instance, when I'm trading earnings and I look back at whether a company beats the expected move most of the time, right? Take a company like Tesla. Most of the time it misses the expected move. So on earnings, I might want to trade a neutral strategy, meaning I'm betting that Tesla's going to stay within a certain range and I can get paid that way. So you can get a lot more creative with options. We're not going to get into all of the complex strategies. I do have a full options course for that, but we just simply don't have enough time. And I want to focus on the task at hand, which is swing trading here. Now, here are the cons, right? You have less control over risk. And you'll see what I mean when we start diving into the risk management portion of this. Options trading is not exact, right? So here's a case in point. If I buy Tesla here, whatever price this is, if I buy Tesla here, whatever price this is, and I set my stop limit here, right? And I set my take profit up here. Let's say that I buy it at 430 and I want to sell it just for shits and giggles at 470. That's $40 of profit per share, right? And let's say that I set my stop limit at minus 20. So if Tesla hits my stop limit, I lose $20 a share. If Tesla hits my take profit, I make $40 a share, right? That's with stocks. With options, if I buy a Tesla call here and Tesla moves up, how much money did I make, right? And we'll see tomorrow with futures, when we start talking about futures, what is the main difference between futures and options? Because with futures, it behaves more like stocks, where you have an exact risk proposition. I know exactly how many dollars a loss represents and how many dollars a win represents, right? With options, it's more of a black hole, all right? How much money I'm going to be making and how much money I'm going to be losing. And you'll see as we go into this seminar that what's even worse, or no, I don't want to say worse, what's even more peculiar is that say that I buy an option here and price comes up here. Say that it retraces and comes back up. The amount of money that this initially represented in profit could be entirely different than this just because of that movement, right? This is why options are very complex. And we'll dive into some of the ways in which you can calculate how much money you will make or lose. But it's not exact. It is really subject to volatility. It's subject to the market moves as well, right? So if I bought an option here and price immediately drops to near where my stop limit is, it's going to be a different loss proposition than if price just inches slowly towards my stop limit, right? Same thing here. When price jumps towards my take profit immediately, the dollar amount that this represents is going to be very different than if price inches towards my take profit. That's why options, one, is misunderstood, and two, requires a little bit more attention for sure. And knowledge. You have to know that, because a lot of times when I'm day trading options, and we're not going to focus on day trading here specifically. We will get into day trading tomorrow. Today we want to focus on swings. But a lot of times when I'm day trading, or even when I'm swing trading, if this stock jumps the next day, right, or very shortly, and say I have a month until expiration, and we haven't yet hit my take profit, I may decide to sell that option, even though my exact take profit hasn't been hit yet, because you get what's called a premium expansion if price moves very quickly in a very short time frame towards your take profit, right? I may decide to take advantage of that options premium expansion, because even though my take profit hasn't hit yet, because if price expands, right, and then starts trickling down over the coming days and then gets back up here, this may represent a less profit than the initial premium expansion. So options are very sensitive to volatility and big moves. Another con is that most options expire worthless. Now, you hear this, and this is kind of misunderstood, but I would say that most out of the money options expire worthless. And once we start diving into here and we get into some of the common traps and mistakes that people make, people tend to buy out of the money options because they're cheaper, right? So like, say for instance on Tesla, let's just stick to this example, that I'm bullish on Tesla. The most common thing that I see people do right now, Tesla's trading at 430, is they'll go up, they'll look at the 430 and they'll be like, holy shit, I'm not spending $1,900 on this option. They'll go up to 500 because they'll look at 500 and they'll be like, oh, it's only, $287. That's the one I'm going to go with, right? Most out of the money options expire worthless. That's why option selling is such a lucrative and frankly, fairly easy game. We're not going to talk about option selling today. We're just talking about swing trading, but we will dive into option selling in the mastermind for sure. But that's why option selling is such a lucrative game, because most out of the money options expire worthless, right? But unfortunately, most noobs, when they are trading options, they look at this and they're like, okay, I'm just going to buy the 500 option. And worse off, they're not even giving themselves time to be right. So they'll go with, say, the November 21st expiration, or they'll give themselves a little bit of time. But, they're not going to go to, say, March 20th and buy the 500 option, because once again, they're looking at price and that's it. And they're treating the market like a sports bet. And you might as well, I swear to God, I'm not kidding, you might as well walk to the nearest 7-Eleven, open the trash can and throw your money in there and close it, right? As opposed to doing that. Or save your money and go to Vegas and have fun. Because sitting at your computer and looking at, a 500 option expiring November 21st, as if you're somehow going to make money on this, you're not. There's going to be 1 out of 50 times that a stock, maybe hits a news cycle and makes a big move, and that's going to reinforce your idea that this is somehow a good idea, even though if you look at your stats, it's a terrible idea. But most out of the money options expire worthless, right? So that's one of the cons. It can be complicated. It is for most people because they don't take the time to watch things like this, but it doesn't have to be complicated, right? And you don't have to know every single Greek. You don't have to know the second order Greeks like gamma and vana and charm. You don't even really have to pay attention to every single movement of every single first order Greek. We will get into which Greeks to look at and how to do it quickly. And then the biggest con I would say of option swing trading is you can't control what happens overnight. And if you do this long enough, you will get subject to, a handful of plays out of 100 where price, again, maybe the stock hits a news cycle and price tanks below your stop. So let's just stick to what we have on screen. But if I have, say I have a long bet on Tesla and I want it, to hit this previous high, and we'll get into technical analysis, which is another thing that I plan to demystify for you because it is a lot easier than people think. You can see that I don't have any indicators on my screen. And at the end of this, you will learn how to trade without indicators because you really don't need them. But let's just say that I plan on taking Tesla to this next high. Say that, I don't know, Elon Musk was caught with, let's make it PG-13. Let's say Elon Musk was caught in a scandal, okay? and the next day the price tanks, and it opens up here. Well, obviously it's below your stop. And with options, you can't do anything overnight. With stocks, now with a lot of platforms having a 24-hour market, you could sell your shares overnight. You can't with options, okay? Some options will trade pre-market, a little bit after hours and a little bit pre-market. Those are mostly the ETFs like SPY, QQQ, etc. But you won't be able to control what happens overnight. Luckily, this is not a common scenario. It is a very fringe scenario and an outlier, right? It's not a common use case. But if you spend as long of a time in the market as I have, it will happen a couple times a year out of 100 trades or more. Which is why it's important to define your risk up front. And we'll get into risk management strategies up front. We'll get into risk management strategies later. All right. So before we dive into the meat of it, what is swing trading? This is different than day trading, and this is different than investing. Swing trading, loosely defined, is a trade that you will hold overnight, okay? It can be an overnight trade. It can go from as the minimum time is an overnight trade to weeks, to days, weeks, months, okay? But it's not an investment where I'm planning on, buying Meta for the long term and sitting on it for 20 years. It's and it's not a day trade where I plan on entering and exiting in the same day. A swing trade is something that you hold overnight and that you can hold for days, weeks, months, depending on your thesis. And we'll get into how to derive a thesis, right? But that's essentially what a swing trade is. Now, why swing trading is easier than day trading? You will find out tomorrow if you haven't already swing traded or day traded before. But day trading is literally the hardest form of trading. There is nothing harder than day trading because you are forced to make decisions immediately. You are watching every candle. You are reacting to every candle. Your P&L is doing this while you're watching it, right? You have to make a decision immediately. You oftentimes make the quote unquote wrong decision. So you might exit for a stop and then it runs your way anyway. That's going to frustrate you. And then you will then be compelled to take more trades because now you're angry and you want to get it back. We're going to dive into psychology as well, which is a huge bonus of this accelerator and something that I think most people are interested in regardless of their skill level. But day trading is the hardest form of trading. Swing trading is much easier. That's the good news because it's slower, right? It's a much slower process. I'm waiting overnight. I'm waiting a week. I'm waiting, 3 weeks for something to play out. So with that inherently comes less pressure because I'm not watching a candle, every single candle every day. I'm not stuck to my screen. And oddly enough, outsized gains. You make way, way more money swing trading than you do day trading. Now, day trading is fun. To me, it's become a job, right? That's how I make income. But then I take that income and I want to put it into swings and investments because the amount of money that you make from swing trading and obviously investing, which is even a longer term proposition, is way more money than you're going to make day trading. Most people are going to lose in day trading, especially if they don't put in the time. But swing trading, not only is it slower, you make way more money, right? Because the moves that happen, you're able to capture much bigger moves. And we'll talk about some of the swing trades that we took recently, some actual use cases. But this swing trade that we took on AMD, for instance, this was 400%. I'm not making 400% in day trading, right? And unless you're YOLOing 0 DTEs, but then your win rate is probably 15%. But you can easily make hundreds of percent, not easily. you can routinely make hundreds of percentage points swing trading. The other awesome thing about swing trading and why it's different than day trading is it's set and forget. So I day trade, but I will admit a lot of times it is torture. I'm stuck to my screen and I am watching every single movement and I'm like, should I get out? Should I get out? Should I add? Should I cut? And it's just this high pressure situation. Whereas with a swing trade, I can, I can open up the market at market open, look at what's happening, have a plan, derive a plan, or make up a plan for what I want to do. If something looks good and I want to take it, and we'll get into what the criteria is for looking good or for wanting to take a swing trade. And then I can come back the last hour of the day and see, okay, is what I thought would happen, is it still holding up? Yes. Okay. I'm going to enter a swing trade. Decide on how much time you want to give yourself. Again, we'll talk about strike price and expiration selection, which is extremely important, obviously. And then I can just enter it and go to sleep. That's it. I'm not glued to my screen, right? Honestly, if I had to pick one, like if I was in some game show and they forced me to pick swing trading or day trading and I can't have both, I would much rather swing trade than day trade. It's not even close, right? I love day trading, but swing trading is that much better in my opinion. All right. Starting to get into the meat of this stuff. Setting up your chart for swing trading, right? So the tools that you're going to need. Must-haves. I assume most of you know this already. But in my opinion, TradingView. I know some of you probably chart on Thinkorswim. I know Robinhood now has more advanced charting than it used to. Before, it just used to have that shitty little chart that you absolutely should not be charting on, because you should not be charting on a line chart, right? Like if you look at the old school Robinhood, it looks like this. You don't want to be charting on a line chart, okay? You want to be charting with candlesticks, and you'll see why as we start diving into how to chart. But TradingView, in my opinion, is a must. And in the follow-up email, I'll send you guys links to where you can get discounts for all this stuff if you don't have one already. And an options broker. These are the must-haves. That's it. TradingView and an options broker. I personally use Public. Not only is Public free, i.e. there's no fees to trade, but they also give you a rebate on your trades, right? So they share in the order flow. Whereas, Robinhood is keeping all this money for themselves. Public gives you a rebate on that order flow. So I've earned $555 in rebates so far, and I really like that. So I will send you guys a link to Public to sign up. And if you do transfer your balance, I think they'll give you up to $10,000, depending on how big your account is. But I personally use Public. If you use Robinhood, that's perfectly fine. If you use Thinkorswim, that's fine too. I've been using Thinkorswim for a long time. But TradingView and an options broker. Now, nice to haves, JEX data, right? Gamma exposure, options flow data, access to fundamentals. We'll get into all of this and how this plays into your option swing trades. But gamma exposure is, you can get it from something like Unusual Whales. And I will dive into this a little bit more as I don't want to spend too much time on it here in the early stages of the Accelerator. But it tells you, if you guys joined me yesterday in my trading, gamma is one of the ways in why I said that the S&P 500 will find support at this level, because there was a lot of gamma at that 6630 level, right? But gamma tells you where dealers are hedged. Again, I don't want to get too much into this, but it shows you at what strike price dealers are hedged at, right? Options flow data tells you where there are unusual options, right? In this case, if you look at NVIDIA yesterday, NVIDIA 210 call, 5.2 million in premium for that 210 call. You can see the volume in options contracts. Do not take trades blindly off of this. You want to marry this with your technical analysis. And luckily for you, you're watching this and you're going to learn this today. Trust me, you're going to get a lot today, at least more in one place than you've gotten in a very long time. But these are just nice to haves, right? You absolutely don't need them, but they will take your analysis to the next level if you do end up using them. And again, I will send you links to all this stuff in a follow-up email so that you can get discounts on all this shit. And then access to fundamentals, right? Now with X, you can do a lot of fundamental analysis on X or ChatGPT. I can show you a little bit of how to do that. But it's not so much having access to a singular news article. That's not what I'm talking about. There is a general awareness here, right? There's a general market awareness that I think a lot of people don't talk about. So I'll give you an example. I get questions a lot about Lululemon, about Peloton, about NVO or United Healthcare. And people ask me, that's fine if you're wanting to invest in these companies for the long term. But a lot of people ask me about these stocks with the intention of buying options on them. So even on yesterday's YouTube live stream, someone was asking me, should I buy United Healthcare calls or NVO calls? When I say access to fundamentals, I'm not talking about one news article, right? I'm talking about having a general idea of what's going on fundamentally in the market. So when we look at a United Healthcare or when we look at an NVO, right? It's clear no matter what on paper these companies are valued at and how good of a value these companies are, and they are extremely great values, right? Like NVO, United Healthcare, on paper, any intelligent investor can see how undervalued these companies are. For an investment, not for a trade. If you can't recognize that, companies that have zero fundamentals, like Iron, right? Or Cypher Mining, for instance, or NVIDIA or AMD, any of the chips, if you can't see or you don't have a general idea that what companies or sectors are in vogue and what sectors are not, you are going to lose in this game, right? And the way that you develop fundamental awareness is by exposing yourself to, maybe traders that or investors that you respect on X, reading news articles, obviously, watching shows like CNBC, not saying that you should take trading advice from them, but just having this general market awareness is so important when it comes to swing trading, because it will allow you to avoid decisions like the questions that I get asked all the time. Should I buy calls on NVO? No, obviously no. Why the hell would you buy calls on NVO? That does not mean that NVO is not undervalued. It is super undervalued, right? For an investment, meaning if you're going to buy this and sit on your ass for 20 years, I guarantee you the stock is going to be up significantly than where you bought it at. But it is not in vogue. It's not the sector that has momentum. If you're going to swing trade, momentum is the number one thing that has to be, is the number one factor that has to be driving your thesis, right? It has to be a sector or a name that has momentum. Obviously, we refine that by going into the technicals. But if it doesn't have momentum, leave it. You don't need to trade it. I don't care how undervalued it is. So when I say fundamentals, that's what I'm talking about. All right. Nitty gritty, how to set up your chart for swing trading. Let's get into this, okay? This is going to be like a technical analysis course here. All right, give me 1 hot minute. Give me 1 second. I'm just going to get some more coffee. 1 second, guys. Don't leave me. Yay, yay. All right. Got some coffee. Order is restored. All right. Here's the nitty gritty. How to set up your chart for swing trading. If you pay attention to anything in this seminar, pay attention to this part, okay? The backbone of technical analysis is support and resistance. I don't care what you're looking at. I don't care what strategy you use. You are using support and resistance, right? The good news is for support and resistance, you really only have to be able to draw a line, okay? Whether it's a horizontal line or a diagonal line. I don't care if you use, what you were taught in the past about indicators, right? Let's say you use moving averages. And I'm looking at something like this, and I'm trading off of the 921 EMA, or you might have been taught the 1321 EMA or whatever. You're still looking at support and resistance. You're using the moving averages as your support, right? If you trade trend lines, so looking at AMD, and this is when I bought AMDs, when we broke out of this, right? Trend line, that is your resistance, right? If you trade break and retest, and we're going to start getting into the strategies here. If you trade break and retest, I want you to look at Tesla, for instance, right? There's a high there. Why did that stop right there? Why did that stop right there? Why did that stop right there? Why did that bounce right there? Clearly, whatever this is a very significant level for Tesla, right? You can see it. All you need is two eyes. Resistance, 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 support, resistance, support, right? Clearly, this is a level for Tesla. So if everything else is aligned, and we'll get into how to add confluence on top of your trades, and we see that Tesla, breaks out and retests this level, that is, you're using support and resistance. Even if you use ICT to trade, you're using, which in my opinion is not the end all be all for swing trading. Trust me, it isn't. You can overlay it on top of, there are times when I overlay things such as fair value gaps on top of my analysis, but it's not the backbone of my analysis, right? The backbone of my analysis is support and resistance. Now, the one thing I think people, and it's understandable, by the way, because I was in your position if this is you. The one thing I think people do is they complicate it, right? They think that there is a textbook that tells you exactly how to draw a line and which touch points to use. And if you don't do that, then you're doing something wrong. So I'll give you an example, right? When I first started technical analysis a long time ago, 2003, but we didn't have access to TradingView. I would say seriously in 2009 on Thinkorswim, right? I would obsess over and I'll get into arguments with people, right? Over, for instance, oh, does the trend line, like, should I draw it like this where we touch multiple points, or should I draw it like this, right? It doesn't matter. It's really not going to make or break your thesis. And then, you get into arguments over, oh, is this a double top here because we have this top and this top? Is that a double top? Oh no, I didn't take a trade because it actually didn't touch the double top. So obsessing over minute things, right, is not going to make you a better trader at all, right? You want to look at big picture. So even when I'm looking at Tesla here, right, before I got really good at trading, I wouldn't see something like that. I wouldn't see something like what I just drew. That wouldn't pop out to me because I'm focused on ancillary things such as or ancillary concepts or auxiliary concepts, I should say, that I read in textbooks. I'll give you a very good example here. I'll look at this and I'll be like, well, that's Head and Shoulders. I read that when I see this, price goes down. That's not how it works, unfortunately, right? Trading like that has a very low success rate, by the way. Now, if you spotted a Head and Shoulders at the top of a trend and you had multiple confluences, okay, maybe you could take a trade off that, but stick to support and resistance, right? The old version of me, decades ago now, would have never seen something like this as a support and resistance level because I'd be fixated on perfection, on drawing perfect lines, right? But if you just expand your lens a little bit into trying to see what's going on and not fit a narrative of a textbook, it will bode a lot better for your trading. Okay, so being able to know really easily that this is clearly a reactive level for Tesla, and if my entry model sets up and we get a retest of this level, then I will want to trade that. Same thing with AMD, right? I took a trade from AMD here. I took a trade from AMD here, but it's not based on any sort of textbook concept. You have to start developing a story or a thesis about why you're taking a trade based on support and resistance. So when I took that AMD trade, right, I saw that this AMD trade from here, I saw that this was resistance in this time frame, right? Price was coiling. We popped above and retested that level, right? Also, if you draw a trend line, again, it doesn't matter how perfectly you draw it. Clearly, out of this channel, AMD popped out of there. So we're retesting really two levels of support. This is called an ascending triangle, but it doesn't matter if you don't know that. Just let's try to logically view this. And we have this channel here, and we popped above and are retesting it. Also, remember what I talked about momentum. Is Tesla a part of the momentum story? Yes, certainly in the second half of this year. Look at this raging trend that Tesla was in, that AMD was in, right? So we had upwards, and then we had consolidation, and then we had a break and retest. I'll get into entry models in a second, but I want you to start framing your ideas around telling a narrative and not trying to fit some outdated, perfect textbook model that likely doesn't work half the time. All right. So when I'm looking at what to swing trade, the way that I set up my chart initially, my chart looks like this with no indicators, right? And depending on the model that I'm depending on what the stock is doing, it's going to dictate whether I want to enter that trade or not. So the main things that I look at here, right? And I'm gonna get back to this, but the main things that I look at here in terms of strategy, right? I'm looking for some sort of break and retest. So let's take AMD as an example, right? Clear downtrend here. We broke above this level. When we started retesting, where did we retest to? What do you have here? A high, and I guarantee you if you drag this back, you have a low right there, and you have a bunch of highs right here. High, 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 low. Didn't touch it, but again, we're not going for perfection. We have a high here, a high here. We broke out and are retesting that level. This is a classic break and retest, and we broke a long-term trend, right? A lot of people, what they'll do, a lot of noobs, what they'll do, for instance, is as opposed to waiting for a breakout, what they're taught to do is they'll look at this and they'll say, oh, there's a low. And I know a lot of people got burned on AMD doing this earlier, but they'll say there's a low and we are coming up on this other low. I learned that this was a double bottom, so I'm going to long. Not going to work most of the time. Trust me, it's not going to work most of the time. You are much better off waiting for a break and a retest. Otherwise, you're going to get caught up in a downtrend. In this case, right? You'll get caught up in a downtrend. Now, it's not to say that the quote-unquote bottom can't be part of your analysis. So, you know, when I'm looking at AMD and I'm like, this is not random, and I know that just because of how much time I spent on the chart, right? You look back and clearly, once again, top, bottom, right? Clearly there's a level here. But I'm not going to long off of that level. And we'll get into this when we get into the traps that people make or that people fall into. But, you know, you could have done that at this low. You could have done that at this low. You could have done that at this low. You would have lost money every single time. You are much better off waiting for a breakout. Now, once we start talking about strike price and expiration, you'll also see why breakout trading is shit. So once we broke out, a lot of people, a lot of noobs will want to buy calls here on this breakout. But very typically, you get a breakout and a low volume retest, okay? And I don't pay attention to volume all the time. I do pay attention to volume on a retest. So what I want to see on a breakout is high volume, as you see here, right? And this this line is just the average volume, but you want to see big volume on a breakout, and you want to see trailing volume on a retest, right? But more often than not, you're going to get a retest of a previous level. Another trap that I think people fall into is gap fills. They think that, all gaps should get filled. And I think that knowing a stock's character is very important here. So if I look at AMD's gaps in the past, right, it's a stock that gaps quite often. Gaps don't have to get fully filled. There's an unfilled gap, unfilled, right? And there's a huge one here. They don't have to get filled, and certainly they don't have to get filled immediately. I would much rather focus on previous levels, right? So again, this breakout and this retest here. If we take a look at NVIDIA, right? We had this downtrend, broke out of it, and we had a retest. Now, if you take a look at the volume, the breakout had above average volume, and the retest had average volume before breaking out again, right? Momentum. Is the stock part of a sector that has momentum? Yes, obviously, chips, AI, etc. If we look at the retest, and by the way, this is not always going to be perfect, right? So there are times where a stock will break out and I'll wait for a retest and say, if I'm looking at this, if I'm being honest here, I'm looking at, actually, let me do I would probably have waited. If I'm trading this specific trade, the specific setup, I probably would have waited for this and would have missed it, right? But it doesn't mean that you can't play a continuation later. But if you take a look at this, right, you had a high, 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 and I would expect to retest that, and that's where I want to take the trade from. We didn't retest that, so it's not going to be perfect all the time. But I think people, one of the common traps is people are always looking to play, like double bottoms, and they're not focusing on a long-term trend that eventually breaks, right? So a break and retest, is one of the most lucrative, patterns one of the most lucrative entry models that you can trade, right? If I'm looking at, there was a time when NVIDIA was horrible to trade, by the way. So if you're looking at something like this, there's nothing to trade here. This is untradeable. And you should ignore this at all costs, right? You want to look for a stock that is breaking trend with a potential retest. Now, it could be breaking a downtrend as well, right? If you take a look at Nike, for instance, this is a very good example. So Nike gapped up. As I said, all you need to know how to do is draw support and resistance, draw a horizontal line. Clearly, this is the support line for Nike. We broke down, retested this gap here. And where did we fall to? this previous area of liquidity, right? Which is this high and this high. We did already go over Tesla. If we look at Iron, right? This is another trade that we recently took. Iron is a series of break and retests. And here's where we get into momentum and trend following, right? So first strategy is break and retest. Really, that's it. Whether it's a break and retest of a horizontal line, a break and retest of, a diagonal line to the downside, a break and retest of a diagonal line here, a break and retest of a short-term trend, break, retest. Now, if you look at Iron, right? Let's just stick to the break and retest for a second. Let's stick to the break and retest before I get into momentum and trend following. What if I showed you this chart and let's say we're here, right? First of all, is this stock part of a sector that has momentum? Yes. Right? AI, mining, AI data centers, etc. Clearly, it's been on an uptrend. What is this right here? A high. That, a high, right? If we got to this level, many people are going to short this because they're going to say, oh, triple top. It could work out. Like if you had shorted if you did a double top short here, it could have worked out. In my opinion, it's a very low win rate strategy that's kind of sloppy. All right, what happened here? We broke out and we retested. Again, all you need is your eyeballs. We broke out and we retested. And we'll talk about strike price and expiration selection in a second. Well, not in a second, but along the way. Is this a viable trade? Yes, of course it is. Break, retest. We have the momentum. More importantly, we do actually have a target. Right? That high right there. So your trade, and I will talk about stop limits in a second, but your trade could look like this. Break, retest, target the next area of liquidity. Boom. Now, say that we didn't get in on that, right? Remember I said that the first thing that I look for is a break and a retest, whether it's of a larger trend or whether it's of a smaller trend. And by the way, speaking of United Healthcare, it did actually do this a couple times. Right? Breaking out of the bull flag, breaking out of the bull flag again, retesting. It did do this a couple of times. Started breaking down after earnings. That's a, you know, that's a point for another discussion, or that's another discussion entirely. Actually, this does kind of look good for a swing. I'm not going to lie. Looking on the weekly. This does kind of look good for a swing. I'm not going to lie. I'll get into why that is in a second. But break and retest, right? We want to look at support turn resistance or vice versa. Change in a long-term trend. And a bonus is if we get a high volume breakout and a low volume pullback. You want to see high volume on the breakout and low volume on the pullback. Right? So if you look at iron here, same example what I was talking about earlier. Look at this. Look at all this volume here. But this, remember, this line's the average volume, right? Look at all this volume on the breakout. Look at how this volume trails. The pullback has very little volume while retesting this level. Now, it's not going to be that clean all the time, but if you see that and the trade fits your conditions, definitely reason to enter, all right? Now, I recently took a trade on iron from here to that 74 level. And if you guys watch the YouTube videos, you know that this was on my list of stocks to get to that 74 level. So if I was a noob trader, right, I would have, and I missed this entire rally, I would have either just said, oh, I missed it, no opportunity, or I would chase, right? I would chase and get burned on a pullback. But even after a momentous move like this, you could still find a trade up here. So when I see something like this, right, say I missed the breakout and retest, and I'm looking at this, well, clearly this is on an uptrend. It's on a stock that's in a sector that currently has the most momentum. So I want to find a way to enter this, but I'm not just going to chase price. Now, remember I said that I typically don't trade with indicators. I'm just looking at levels. I'm looking at highs and lows. And in some cases of a strong downtrend or uptrend, right, I'm looking at diagonal lines. Like this, like this. But when I'm looking at this and I'm like, this is every time I look at the stock, it's just going higher and higher. And I want to try to get back on a pullback. Now, one thing I could do is if the stock is pulling back, right, I could look for a level, go to the left and look for a level. The problem is this is trading at all-time high. There's a level here, but we're not going to get there. That's already surpassed. So what can I do? One thing in this case, in this very specific case, is I like to pull up moving averages, okay? Now, which moving averages do I pull up for momentum, right? Because if we look at this, The two strategies that I use for swing trading is a break and retest and momentum and trend following. That's all you have to remember. And I'm also going to show you an example of a trade that didn't work out recently as well. The moving averages that I use are, for this type of trading, 921. Because if you take a look at any stock that has momentum, right, whether it's Tesla or Nvidia, they're all hugging the 921 EMA because those are called fast moving averages, right? I'm not looking for moving average crossovers or any of that. I think that all that for swing trading is bullshit. You can, by the time that the moving average crosses over on the daily chart, and say you tried to short this, the trend, or the trend continues upwards, right? Moving average crossovers on an uptrend, say it crossed over to the downside, very misleading, especially in something that has a lot of momentum. So I'm not looking for a crossover. I'm looking at a stock that has momentum, and I want to trade a retest, and especially if I don't have a previous level to trade off of, right? I'm going to wait until it tests the 21 EMA here. Now, can I add confluence? Yes. Once again, you have fundamental confluence in this name, right? At this date as well, Iron had moved up their earnings by a month because there was expected good news on earnings. That's only something that you're going to know if you're reading about the company. And it's signing deals left and right in the AI space, right? So once we tested that level, once we tested the 21 EMA, there is a gap here, right? You can see there's a gap there. Obviously, there's a high here from this candle. So testing gap high 21 EMA. If I pull up the volume, do we still have volume on the upswing? Yes. As a matter of fact, this is the most volume the stock has ever seen. On the retracement, is it lower than average volume? Yes. Right? You have more volume on the uptrend, low volume on the downtrend. And where would I target if I took this? Again, all you need to know how to do is draw a horizontal line. And because the stock is at all-time highs and I don't have previous reference, I have to target this high. Right? So if I entered here, and I'll again, we'll talk about which strike price and expiration and how to set your stop limit or whatever. This is the type of trade that I would take 10 out of 10 times. And this is a trade that we did take. So really the main two strategies, break and retest, momentum and trend following. Now, here's a trade that I recently took that I did make some money on the first batch, and then I lost, it basically broke even on this trade. Let me remove all this. So this is an AI company called Path. It's a software company, right? Now, what struck me initially, if you're taking a look at this and you know what we've learned so far, and let's say that you see this, right? What about this is going to attract your attention? And I'll show you how to pick stocks to trade. I guess. How to even find this, right? But one, it's in the AI sector, a lot of hype. Two, volume went absolute ham, and that's part of the reason why I found this is because of the volume, right? Three, does it have definable levels? You can see there's a top, multiple tops. Again, this day closed at this top, and then we finally broke out, right? We break out with amazing volume. Again, more volume than this company has ever had historically. And we retest. We retest this with low volume, right? And for those that are asking what, this is just the regular volume. I don't know if you're asking because I have the chat off. I will turn that on for Q&A later, but I don't want to get distracted here. This is just the default volume in TradingView. If you're charting in Thinkorswim or something, same thing, right? They all pull from the same data set. You have these highs, break, and retest. You do not need indicators for this. All you need is your eyeballs. So you have sector confluence. Again, if you know more about the company and you read up on the company and the hype that's associated with the company, even bigger bonus. We broke out of here and we retested this, right? So why did we drop from here initially? Well, if you look here, there is a huge gap, which is considered resistance. So it's not surprising that it faced some resistance here. And I want to see very low volume on the pullback to a level that I can anchor my trade from. And if I take a trade here, right, I want to put my stop at a recent low. And I want to target these highs. Now, I obviously could be ambitious and greedy and be like, oh, there's that high there and that high there, and there's this high here. I'm going to target all those highs. Okay. Once we get into strike price and expiration, you can target these highs if you like. You better give yourself enough time. If you're going to target these highs, you got to buy more time, right? And with options, remember, they're time-based instruments. The more time you buy, the more expensive it is. So I cannot target these highs ambitiously with a shorter term expiration. And you don't need to in order to make money, right? Like I can buy, I can trade just this nearest high and still get a 2-to-1 trade out of this. Now, initially, this did jump, right? We did get premium expansion. Again, we're going to be talking about this. And I took some off here, but I left it. And eventually, this stock came down and hit my stop. You're going to have losses, okay? Just because you set up your chart perfectly, etc., it doesn't mean that you're not going to have losses. You have to manage your risk. It's like a football game. Do you know how many plays are called in a football game? Hundreds are called in a football game, right? How many touchdowns on average does a football game have? 3? So you're attempting multiple times in order to get your desired outcome while managing your risk, right? So even in a football game, on every down, they're managing their risk because they don't want to lose yards or worse off, get a turnover, right? They're still managing their risk. They try 4th down, they got a punt. Okay. Next possession, they try 4th down, they get a punt. Okay. Next possession, they try, right? They're still not doing stupid shit in the middle of the game most of the time where they lose yards or get points scored against them. At least that's not the goal, right? So you are going to get your stop limits hit. That's the point of managing your risk. And we'll talk about risk management in a second, right? By the way, this trade could work out from here. If you look at the volume, it's still very low. And instead of finding support at that area of liquidity, right, we are now in this gap. And we do have a very important level here. Highs, right? If I wanted to, I could re-enter this trade. Depends on what else is in my portfolio. And I could manage my risk like this. First target, second target. Especially because we had extreme volume on the push up and limited volume on the retracement. So support and resistance is the backbone of all TA and will be the backbone of your swing trading. Key levels, right? We're going to be talking about key levels as it relates to day trading tomorrow, but key levels as it relates to swing trading are really just former highs and lows that are tested multiple times and trend channels. And in terms of the time frame, the good thing about swing trading, you don't need to use any time frame except for the daily. You don't need to switch time frames. Now, once you get really good, if you wanted to drill down and look at the 4 hour for a little more granularity, you can, right? But you certainly don't need to. You can just look at the daily for your levels. With day trading, it's completely different. With day trading, you're going to be switching time frames. You're going to be looking at the 5 minute, the 3 minute, the 1 minute, the 15 minute, the 1 hour, the 4 hour. That's a whole other beast. Luckily for swing trading, you don't need to look at anything but the daily. All right. So here are some common traps. Fixating on reversals. I see this all the time, right? We just got an example or talked about an example with like NVO. There's going to be a lot of people that buy calls here and they're going to get burned, right? Fixating on reversals. Like, oh, this is the bottom. It's got to reverse. I'm going to buy calls because how can it go lower than this? You're going to throw money in the trash doing that. You have to learn how to change your thinking when it comes to the market. Trends freaking matter. Look at this trend. I do not care to trade this. Now, again, buying an investment, perfectly fine. This is one of the most horrific, horrid charts on the market, NVO. But oddly enough, it does have my attention here. Why is that? Look at your eyeballs. And no, it's not the head and shoulders. I already showed you why on Tesla, for instance, this means shit. The reason is because of these lows. Low, lows, low, low, low. This is a level here. Now, if you were to look at this and you looked at the company's fundamentals and you said, I want to buy this stock for the long term and put it in my IRA. Fine, perfect. If you looked at this and said, I'm going to buy calls, close your account. Do not buy calls here, okay? Not saying that it can't hit. You can get lucky, and it can hit. There's no momentum here. Your options are time-based instruments. And when we start talking about theta, you're going to see exactly how much money your option loses just by its existence every day, right? Your options, when you buy an option, it's like buying a brand new car off the car lot. The minute you drive off, your car starts losing money and depreciating. Same thing with options. The minute you buy it, it's starting to depreciate. So this is a very key level, and I'm paying attention here. Not because I want to buy calls, but we have a trend line, right? We have a long-term trend here that's far from tested. We have a shorter-term trend here that's probably easier to co-locate or to locate, sorry. And I want to see if we break out of this. Say we break, okay, here's a great example. Say we break out of this and we retest this level. Why this level? Easy. High, high, low, right? And I bet if we go back far enough, you'll see that this right here is a very important level. So say we break out of this trend line and we retest this, and I look at the volume, and on the breakout you have a ton of buy volume and it retests. Yes, this is a valid area to buy calls. Where would you target? You have a high here and you have a high here. Those would be my short-term targets, right? Now, this is not the same as buying leaps. Leaps are just a stock replacement strategy. So you can consider leaps an investment, but you better go out a year or 2 years on your leaps if you buy leaps here. We're talking about swing trades, but there's no way in hell that I'm just buying calls praying for a reversal. So do not fixate on reversals. Let the market show you its hand. How does it show you its hand? Break and retest. It's giving you a gift. The gift of break and retest is unlike any other in the market. It tells you what it wants to do as opposed to you trying to guess what it wants to do. Pattern traps, thinking every double top is a short, every double bottom is a long, every head and shoulders is a short. Get out of that mind frame. Focus on support and resistance. Rushing to enter breakouts. Now, once we start talking about strike price and expiration, you'll see why breakout trading in options trading is so dangerous, okay? Again, you can get lucky if you're someone that just buys options and you don't manage your position and you let every option go to zero, and, you know, say you buy the breakout on AMD and on this retrace, you're down 65% and you're just holding on for your dear life. And then it magically turns around and you're like, woohoo, I'm a genius. Most of the time it's going to kill you. Okay. Do not chase the breakout. And there's a reason for this. Aside from it being a horrible idea, there's an actual reason for this. So if you bought the breakout in stocks and you just bought shares, not that bad, okay? Yes, you will be down on a retrace, but you are not subject to external factors beyond the stock price. So if I bought this, if I bought AMD at 120 and it drops down to 110, yeah, I'm down $10 per share, but I'm only down $10 per share because that's the absolute price of the stock. If I bought call options on this, call options come, unfortunately, if you're on the losing side of a trade, with all these Greeks. IV and delta affect an option stock price, an options price. On a very huge move like this, you're getting expansion in delta, expansion in IV, which means that the premiums are high, right? Remember what I said at the outset. if a stock makes a huge move immediately versus a trickled up move, even if they end at the same level, the options price is going to be different. The one that has the huge move initially is it's going to represent a lot more money up here than a trickled up move, even though the stock is at the same price level. So if you buy the breakout here, the retrace is going to be painful because you bought when the premiums were inflated and now premiums are decelerating quickly. So even though this seems like a small drop in an option, it could represent 50, 60, 70% decline in your option, even though the stock price looks to have dropped a little bit, right? If you're looking at the stock from here to here, talking about 11% drop on an option, an 11% drop could be, I mean, depending on the expiration, it could even be 90% lost. So if you're option swing trading, you do not want to rush and enter breakouts. Not recognizing the stock or sector you're trading is not in vogue. Like I said, a lot of times I'll get asked about Lululemon or Peloton or, NVO. You want to be trading a sector that is in vogue, a sector that has momentum. Momentum is your best friend. Chasing price, not paying attention to options premiums. We just talked about this. Another common trap is always buying out of the money. When we talk about strike prices, this will make more sense. And then obsession with short expirations, right? Again, people are fixated on this. And so they're like, this is so expensive if I buy this option. What if I go out next week? Okay, it's a little cheaper. What if I go up the options chain? Oh, these are really cheap. I'm going to make this bet. There's a reason that these prices exist, right? There's a reason they're different. None of these are created equal. It's not this. If I bought the 500 call expiring next week, it's not the same thing as buying the 400 call expiring next week. Entirely different risk proposition, right? A lot of people ignore that and they just go for the cheapest bet and they think that the bet is the same all across the board. It's entirely different. So we're going to get into strike price and expiration. Right now, we've been going for an hour and a half. I say we take a little bit of an intermission, go drink water and grab something to eat, get more coffee, go pee if you need to. And we'll be back in, let's say, 5 to 10 minutes. Let's just give it a time. Let's say it's 9:30 my time, 12:30 Eastern. Let's say 12:40 Eastern. So 10 minutes, we'll be back. And we'll carry on with how to pick strike price and expiration, what to look at with regards to fundamentals, talk about risk management, stop loss, take profit, position sizing. There's a lot to get into that's still very, very important. Hopefully you guys have been finding this helpful. I'm enjoying this so far. I'll see you guys back in 10 minutes, okay? 12:40 Eastern. What is going on, guys? Damn, where did everybody go? Like 200 people left. Just off a 10-minute break? I feel offended. All right. We'll do a Q&A after. So the chat is off for now, but we'll do a Q&A after. So let's get into strike price and wait, am I on? Yes. Let's get into strike price and expiration, right? This is another area, not surprisingly, because options, like I said, are a little bit more complicated. And you'll see tomorrow why futures. What are some of the advantages of trading futures? But monthly options will always have more liquidity, right? And what do I mean by this? If you take a look at an options expiration chain, you could see that there are weekly options expirations, November 14th, November 21st, November 28th, December 5th, etc. Once you go out further than a couple months, though, these options, the option chains for the weekly don't open up. You only have monthly expirations, right? And as time moves on, the weekly options will open up for these monthly options in the future. But the monthly option, meaning the third Friday of every month, November 21st, December 19th, these are the monthly options. These options will have way more liquidity than the weekly ones. Now, why is that important? When you're dealing with a stock like Tesla, Tesla does have quite a bit of, it is one of the most popular stocks to trade, right? So it does have a lot of open interest. Open interest means the contracts that are open. When you're trading a stock like, say, Netflix, which it hasn't split yet, so Netflix options are very expensive, you can see that Netflix options don't have a ton of open interest. So if I go to the December 5th expiration, you can see some of these are in the double digits, and this is like everybody in the world, right? For the 1,080 call expiring December 5th, there's only 31 contracts open. For the 1065 call, there's only 13 contracts open. For the 1060 call, there are 0 contracts open. So you do not want to trade options that don't have a lot of volume, right? Because if you try to trade this, the bid ask is crazy. It's horrible because it doesn't have a lot of liquidity. So if you look at the bid ask of this option that has 0 open interest, the bid is 62.40. The ask is 67.30. We're talking about $5 difference between bid and ask. Meaning if I bought this right now, I'd be paying close to the ask. And if I sold it 1 second later, I'd be selling it for the bid. So I'd immediately lose $500 just for opening that option, right? So you want to stick first and foremost to one, a stock that's liquid, and we'll talk about how to pick stocks to swing trade options. You want to trade a stock that's liquid like Tesla, but you also want to pick a strike price and expiration that has a lot of liquidity, right? So the monthly options, meaning November 21st, will always have better liquidity than the weekly options. That's not to say you shouldn't trade weekly options, but on less popular stocks, or the less a stock is popular, the worse the bid-ask spread will be, right? Now, in general, I typically, when I'm swing trading, I won't go short-term expiration anyway. So let's say that I want to buy calls here, right? And I want to trade it to the most recent high target. I'm not going to be buying November 4th, 14th calls, or even November 21st calls. I want to go at least a month out. Now, the reason is this. A lot of reasons, but one of the things we'll be talking about with regards to psychology of holding swing trades, these are daily candles. A lot of people get caught trying to day trade, and they're trading 5-minute candles, for instance, right? When I'm looking at this, each candle is 5 minutes, or even worse, if you're looking at a 1-minute chart, you're looking at this bounce up and down every day. Swing trading requires an entirely different temperament and disposition. These are daily candles. So imagine how, if I am on a 5-minute chart on the S&P 500, for instance, and let's just look at this break and retest here. Right? Break and retest, and say I want to go long on this, and I end up going long here. I actually took this exact trade yesterday on NQ. But say I want to go long here, right? Each candle is 5 minutes, so I'm sitting there waiting. When you're daily, like, look how many candles it took to finally push up. 1, 2, 3, 4, 5, 6, 7, I don't know, 10, 15 candles of 5 minutes. So if I'm looking at something similar, but on the daily chart, you have to figure that it will take weeks to get to, it could take weeks to get to my target. Obviously, if it doesn't immediately, great. But this is where people shoot themselves in the foot. They don't account for the fact that these are daily candles. And these daily candles take an entire day. So like if the next day stalls out a bit, and the next day stalls out a bit, and then the next day it kind of drops a bit, people are like, oh my God, I'm so frustrated. You're looking at daily candles. You're not looking at a 5-minute chart, right? So expect, however this behaves on each candle, expect that to behave in the same way. But instead of 5 minutes, you're talking about days. So you have to give yourself enough time. So in general, if I'm trading something like this, I'll give myself at least 30 days. A lot of the times you also have to base it off of the character of what you're trading. So if I'm trading, like, if we go back to the example of IREN, if I'm trading this and I'm, swing trading this trend here, I will be less concerned about going out further in time. Meaning 30 days, probably enough. If, depending on the setup, right? You could go a little bit less, assuming that the liquidity was there, right? So if I wanted to go November 28th, which is 20 days from now, as long as the bid ask is there, I could trade something shorter term, because one, it is going to be cheaper for sure. The less time you buy, the cheaper it is. And two, if it makes a big move, you're going to make more percentage wise from shorter term expirations. That's why people are addicted to zero DTEs, meaning options that expire today, because they like seeing that 2,000, 3,000% gain. But most of those options end up expiring worthless, right? But people like to see that. So on a stock that has a lot of momentum, you could go shorter expiration. I generally will not go shorter than 2 weeks. If I do go 2 weeks on something like iron, I will be very prepared to roll this if it's stalling out or hasn't taken a while, right? Like if after 2-3 days it's stalling out, remember your option is losing money just by the virtue of it being open every day, i.e. theta decay. Then I'll likely roll it out. But in general, I don't go shorter than 3 weeks really. And for most things, I'll go at least a month. Now, if I'm trading Tesla and I see this and Tesla's just been consolidating, on something like this, I will likely go 2 months because I know Tesla's propensity, or at least Tesla's ability to consolidate. You will, if you want to trade this, you have to buy time. You cannot say, I'm going to buy next week's expiration on Tesla and I want to buy calls. You're likely going to lose money on that. So know what you're trading, right? And if it's too expensive, guess what? It's even more expensive to buy a shorter term option that's likely going to expire worthless. You're just wasting money, right? I get that Tesla options are expensive. So if I go December 19th, for instance, and I want to buy calls on Tesla, yeah, they're very expensive. So guess what? Don't trade Tesla. Don't just buy shorter term options and go super out of the money so that you can enter a trade. The less time you have, the more volatile, right? So if I'm trading an option, as I said, if I'm trading an option that expires soon, it's going to be way more volatile to price changes, both in terms of the direction that if it goes in a direction that's favorable to you or if it goes against you. It's going to be, the price jumps are going to be way more, the percentage jumps are going to be way more volatile. So if I enter a December 14th call on Tesla and it jumps up, that option's going to make, quote unquote, a lot of money very quickly. Same thing if it drops, right? Should you go out of the money, at the money, or in the money? Here's my general rule. I don't go out of the money that often. Okay. I don't go that out of the money that often. It's a trade-off between the liquidity available for that option. It's a trade-off between the liquidity that's available for that option and how out of the money it is. So if I'm looking at something like, this is a perfect example, right? Let's just stick to something like iron. And let's say that I want to buy calls and I go November 28th, right? Which is in 20 days. Right now it's trading at 62.38. If you look at, this is another rule, is that options that end in 5s and 0s have way more liquidity than options that have odd values, right? So if you look at the 65, it has almost 2,000 in open interest. If you look at the 70, it has 2,400 in open interest. If you look at the 68, it has 257. If I look at 61, it has 192. But if I look at 60, it has 1,200, significantly more, right? It's just the nature of, it's just human nature. They love round numbers. Humans love round numbers. So the ones that end in 5, the ones that end in 0 are going to have more liquidity. So if I'm trying to trade this, right, I'm probably not going to pick the 62 or 63 or 64 call. It's going to be a choice between 65 and then going in the money at 60. Now, the shorter time you have until expiration, in my opinion, the more in the money the option needs to be. So if I was trading this and I thought that it would make a quick move, I would likely not buy the 65 call, or for sure not going to buy the 70 call, right? I would likely buy the one that is a couple strikes in the money. Now, a lot of people don't like that, because a lot of noobs don't like that, because they're like, oh, this is expensive. I'm just going to trade the 70 call because that one's half the price. Yes, but this one has a much less likelihood of hitting, right? So if you look at, for instance, on something like this, obviously these aren't real time because the market is not open, but this is likely the last values before market close, right? If you look at this, the theta is what? $16. So this is losing $16 a day. The 60 calls, losing $16 a day. But look at the delta. Every dollar that iron goes up, this is going to make 61 bucks. And I'm going to get into this explanation in a second. If I go to the 70 call, every dollar that iron goes up, this only makes 39 bucks. And the theta is the same. However, I'm losing $16 off of an option that costs half, which means this theta represents much more of the value of this option. And if the price goes up, I'm not even making that much, right? Now, obviously, if the price starts accelerating and this goes in the money, then delta is going to increase. But the chances of that happening before my option bleeds out is very slim most of the time. So on something like this, I would typically go, I'm looking at the risk reward. Instead of going so out of the money and trading, and instead of trading the odd values, not odd as in odd even, but weird values like 62, 63, 64, my only choices really are either go in the money at 60 or trade the 65 call, right? As I said, the less time that you have, the more that you have to consider going at the money or in the money. Now, I don't mind going slightly out of the money. I'll give you an example. If I'm looking at NVIDIA here, right? And NVIDIA does definitely have a break and retest scenario, by the way. Broke out of this trend, retested all these highs. You can see all these highs here. Bunch of highs, highs. Even tested it as support back in October. This level is so important for NVIDIA. We broke out of it and are retesting it, right? Let me remove the moving averages. And NVIDIA obviously is part of probably the leader in momentum for this entire AI bubble. So say that I wanted to trade this, and I just want to take it to the nearest high. Right now, NVIDIA is at 188. NVIDIA can definitely make huge moves very quickly. If I go and I want to give myself at least 30 days. I'll go December 19th. Remember, the monthly options expirations are going to have way more open interest than the weekly. Although in something like NVIDIA, which trades with a lot of volume, you can pick the weekly options. They will be okay. Not as much liquidity as the monthly, but compared to other stocks, the weekly options look fine. Personal preference, though, I still most of the time would rather go monthly expirations. So December 19th, now I don't mind buying the 190 call on NVIDIA. We're at 188. My target is, 210, around there. And NVIDIA, if it does make a move in my favor, usually moves pretty quickly. So I don't mind buying the 190. If someone even wanted to buy the 195, not my style, by the way, but I don't mind as long as your risk is managed. So if you do end up opting for the 195 call, you better be prepared to roll it within a week of the stock not moving. Because remember, theta, you're losing money every single day by holding the option. In this case, this is losing like 1.5% every single day just by holding it. And that's not even accounting for if price drops, you're losing $45 for every dollar that NVIDIA drops, right? So if the days move along and NVIDIA hasn't moved up and you have the 195 call and, we're sitting in the mid 180s, you definitely want to roll it out and buy more time, because the more that time passes, an out of the money option will accelerate in losses. And this is what I think people don't get, right? So if you do go out of the money, significantly out of the money, like 195 or 200, you could certainly do that, but you have to be prepared to roll it when there's 3 weeks or less left. A lot of times people will come to me and they'll say, I have the 200 call on NVIDIA and it expires this Friday. Okay, well, NVIDIA's 188. Yeah, what should I do? I don't want to lose money. Well, tough luck. It's gone. Unless by some miracle, Tesla goes significantly in the money by Friday, that option is gone. Even at 200, that option is worth $0, right? So it has to be significantly above 200 to make money at expiration. So you have to manage your options. And in my opinion, if your option is out of the money and there's 3 weeks left, you should roll that. You should roll that forward. Or close it, by the way. No shame in closing it. So bid-ask spread, like I said, on very liquid options, right? So if you look at the 195 on NVIDIA, expiring December 19th, has 27,000, right? So if I click on this, the bid-ask, even when the market's open, will be even better than this. But on something this expensive, right, it's a very low margin between bid and ask. And you want this to be the case, because if you buy it and then you're forced to sell it, you don't want to take a big hit just by the sheer existence of a wide bid-ask spread, right? You want the bid-ask to be tight. That way, if you buy it and sell it, if you're losing money, it's only by virtue of the fact that the stock isn't moving in your favor. But you don't want to lose a big chunk of money just because the bid-ask is so wide. Common mistakes, going too far out of the money. You basically never want to do this. Now, if you're trading a lotto, and I don't recommend that you approach the market like this, only if you're really good at trading and there's something that you're like, hey, I'm willing to take a lotto on this. It doesn't represent anything, any significant portion of my account. Sure, I understand the market can be fun at times in that way, but in general, your trading shouldn't be you shouldn't be looking for excitement. You're looking to make money consistently, right? Like a job. You're not looking for, oh, I really want to get that hit. If that's you, this video is not for you, or this seminar is not for you, right? This is for those who want to consistently generate income and take their trading to the next level. It's not to be excited and hit YOLOs, okay? So in general, you don't want to go too far out of the money. You want to understand the character of the stock that you're looking at. If it's something like Tesla, where it can spend a shitload of time in consolidation, you will need to buy more time. Otherwise, don't trade it. If it's something that has a lot of momentum, like a break and retest on an AI stock, for instance, or a trend following off the 921 EMA, right? You can go out of the money. I still wouldn't go too far out of the money. And it's a trade-off, like I said, between the liquidity of the option and how close to the money you can get. So in that example, again, with iron, it's fine if you wanted to trade the 65 calls while it's sitting at 62, but I wouldn't go, I wouldn't trade the 70 or 80 or 100 calls on iron. I think that's a waste of money for sure. Common mistakes, not narrow, bid ask too wide. And then choosing the cheapest option, usually that's a waste of money, right? Like if you're just looking at the options chain and this is what's driving your opinion and not this, yeah, you're doing it all wrong for sure. Now, when we get into risk management, I will talk about the Greeks that you need to know, okay? Because without knowledge of at least a couple of these, you won't know how much money you're going to make or lose by buying options. Remember how I said it's not like futures. If I bought an option here and it ends up here, how much money did I make? The answer is complicated. It's not fixed like it is in futures or option or stocks, sorry. All right. Fundamental cues. Momentum in individual name or sector, right? Obvious one being AI. So for instance, on AMD, you can marry the fundamentals with the trend. Like once this trend changed, and if you're tracking AMD, you see that there is a shortage in the market for being able to, there's a shortage of supply in the market to meet the demand for chips. There is really only one other company besides NVIDIA that has a comparable product, right? There are other chip companies, but not in the GPU space. So when you talk about Intel, you're talking about CPUs. When you talk about Marvell or Qualcomm, right? You're talking about components of chips or chips made for specific components. But when we're talking about GPUs, you really only have NVIDIA and AMD. And AMD is not even a close second, but it is a young company. When you look at the market cap of an NVIDIA versus an AMD, AMD has clearly more room for growth. And that's why I was saying this is a company that can double its market cap quickly. Can NVIDIA double its market cap from here quickly? No, it's a $5 trillion company. It's going to be very hard to get it to 10 trillion. But if AMD is 100 billion to get to 200 billion with the momentum, sure, yes, it can. And it has, right? So knowing the sector that it's in, knowing something about the company and its recent trend, marrying that with technicals is very helpful. Also, the proposition that AMD was going to sign some more deals. This jump here was on the OpenAI deal. Now, you could have heard some rumblings about that. You don't have to know exactly. But as long as the momentum from a fundamental perspective is there, that can help you. News overreaction. So Google is a great example of this. When Google had dropped to the 140s, and the search is dead narrative was really ever present, and it dropped to this level. You can even see my old markings here, but these are highs, lows, lows, and it dropped to this level. Google was both a swing trade and a long-term investment for me, but there are multiple ways that you could have attacked this, whether it's a break and retest of this level, or the more sensible thing to do would be to wait for this trend change. Then you have a break and retest of not only this trend line, but this level here. Remember, TA doesn't have to be tough. It can be just as easy as this. But certainly this was an overreaction, right? And the fundamentals were there for Google, and you could have waited for a momentum change, even if you didn't take this, right? You clearly see now it's making higher highs and higher lows out of this, off of this level. There were many ways to enter this. Again, if you pull up the 921 EMA, a very easy way to follow trend. If something is trending, it will likely follow this. If you wanted to enter off of the 921 retest, you can. If you wanted to marry this with break and retest, you can. So if you didn't enter here and you see this series of highs, series of lows at this level, lows, highs, it really is that easy. I think the mistakes that people get into with options trading is what they make it harder on themselves. So if I'm gambling and I'm buying out of the money options and I'm just holding them until they go to zero, and I'm like, fuck, nothing is working. I suck at options trading, man. Nothing's working. I keep doing that. As opposed to stepping back, it really is that easy, right? In terms of how to set up your trade. It doesn't mean you're going to hit every single one, but you have a trend, you have a narrative, it's clearly breaking out, and now you have a break and retest scenario. So even if you didn't get on this, here's another break and retest. Say you didn't get on this. Well, now we're following the 921 EMA on Google, right? This is the previous high. So you had a target all along to get to this high. Once it's trading at all-time highs, it is very hard. You could still trade the 921 EMA. And even now, if Google hit the 921 EMA, you could still long that. It doesn't mean it's going to work until the trend's broken, but it's still a good trade, right? Even if there's no anchor here to go off of. And then overall market sentiment. This is very important. So a lot of times, especially when I'm trading mega caps, right? I'm looking at the overall market sentiment. I'm looking at the NASDAQ and the S&P. Yes, there are stocks that on occasion will ignore the NASDAQ or the S&P. So like the last week when the market was dropping, Apple really didn't suffer a drop. It's just staying put here, right? In general, a rising tide lifts all boats, and a sinking tide sinks all boats as well, right? So there are some things that are obvious, that are disconnected from the indices, right? Especially like some of these pre-revenue names like Oklo, for instance. In general, you want to trade with the market trend. So say that I'm expecting a huge downturn in the market. I'm not going to take a bunch of longs, even if the setup is there, right? It's going to be, you're going to be making it very hard on yourself. And I think that, yes, there are times when an individual stock setup looks so good that you just have to take it. But in general, you want to be trading longs, or looking for longs or long setups when the market is rising, and you want to be looking for breakdowns when the market is tanking, right? You don't want to do the opposite. I think market sentiment is very important. There are occasions, like I said, where I will long something if the market looks weak or if it's consolidating. Usually that stock is not in the S&P 500, right? So if I'm longing iron, this is not in the NASDAQ. This is not in the S&P 500. So if a long setup presents itself, the market could be consolidating or looking a little bit ugly, and I might take a long if all of the conditions for a long are there. But in general, you want to trade with the market setup. A couple of other things here, fundamental cues, right? I talked about flow. Now, this is something that I could do a whole mastermind on, flow and gamma exposure, okay? I think that this can be a double-edged sword because I see a lot of people who, again, still think that technical analysis is hard. They think that options trading and the Greeks and all that is hard. They don't want to put in the time, and they would much rather look at an easy tool and be like, whoa, there is a large order. I'm going to enter calls too. You're still going to shoot yourself in the foot. This has to be a confluence along with your setup, right? So I took calls on NVIDIA in full disclosure on Friday personally. And let's just walk through in real time what my thinking is behind that. If you look at the market, and I don't day trade using moving averages, but for long-term analysis, like I said, there are occasions when it is valuable. 921 EMA, really good for trend following. If you have, say, a pullback or a correction in the S&P 500, yeah, you're going to start pulling up the 50, 100, 200 moving averages, right? The 100, 200 rarely get touched. You can see last year there were a couple times where it did get touched. But coming out of this huge Liberation Day downturn, right? This is the first time that we're testing the 50 moving average, the 50 SMA. This right here is called a hammer candle, right? It's basically where there's huge buying into the close and we get a nice full-bodied green candle, right? Like there was weakness on the day and we ended the day pretty strong. From a fundamental perspective, I think that the government is opening up. I think the Fed is going to cut. I think the Fed is going to start money printing again. I don't think the government shutdown is going to last a very long time. I think that's going to be a bullish catalyst. This right here is weakness partly because of the government shutdown and no data, right? So when I look at NVIDIA, obviously follows the broader market. I talked about this level, right? Break and retest. I bet you if I pulled up the 50-day moving average, yep, it's sitting right there on the 50-day. All of that looks fine to me. And then I see this. So 5 million in premiums for the 210 call expiring December 5th. Now, obviously, it does have earnings coming up on the 19th, right? And this could be an earnings play. But let's leave earnings aside for a second. This is an added confluence only because of how the chart and my narrative, the thesis that I built around that trade, look, right? I'm not looking at this and saying time to buy calls just because this is this print. Okay. So this can be used as another fundamental aspect, knowing that there is a huge number of calls. And 210, by the way, would be my profit target up here. And look, this is December 5th, right? I bought the December 19th calls. So another mistake people do is they follow the exact same contract as here. But it's like, if you have to think critically and logically, if you're using this as a point of confluence, you don't also have to take a very risky play. You can set up a better play that still relies partially on this data. Okay. Anything else about that? No. So you want to marry your fundamental analysis on top of that. Now, it doesn't mean that this is not fundamental analysis in the sense of an investment. So a lot of stocks that I'll swing trade are bullshit. Oklo, Iron, these companies don't make money. So if I looked at them fundamentally on paper, I'm like, what is their PE ratio and their price to sales? Yes, they look horrible. I mean, Oklo doesn't even have revenue. It's called a pre-revenue company. So fundamentally, from an investment standpoint, it's horrible. When I mean fundamentals, I'm talking about this stuff. Momentum in the individual name or sector, any news surrounding that, right? And then overall market sentiment. You can marry it with big orders that you see as well. So I'm not talking about PE ratio and cash flow. Those are great for investments, not for momentum, which swings require. Okay. All right. Position sizing. Let's talk about risk management. Is there something else I wanted to talk about? There is, as it relates to the chart. I will get back to that, but I want to get into this first. So risk management, right? Position sizing. You're probably sizing too big too frequently. I'll say this right off the bat, only because I've worked with thousands of traders now, and I've seen all of the mistakes that new traders make and mistakes that we've had to work with them to fix. You're probably sizing too big too frequently. And I see this all the time, right? I'll say, I'm buying the NVIDIA or Tesla calls. Literally the next day, like it could be down 8% or 10%. And people are like, are you still holding? Do I sell it now? What should I do? It's because your P&L probably looks like shit compared to your account size, right? The 2% rule, something that I wholeheartedly believe in, your risk should not be more than 2% of your account. Meaning if you are trading, if you are putting up $2,000 of risk, you better be sure that your account's $100,000. A lot of people don't want to hear that, right? Because they got duped by some person online who's like, let's do the 500 to a million challenge. Yeah, that's not going to happen, okay? You are not going to turn $500 into $1 million. This is not the lottery. You're looking to make consistent gains week after week and compound those gains so that you can eventually get to 7 figures. That's not going to happen for $500, okay? So you should be growing your account in order to trade it properly. And your risk should not be more per trade, should not be more than 2%. Now, full disclosure, are there some trades where I will go 10% of my account? Yes, but that's me. I've been trading for over 15 years. If you are at the point where you understand that and you're looking at a setup and you're looking at the fundamentals and you're looking at all the confluence points and you're like, this is a once in a year opportunity, I'm going to risk 10% of my account. Perfectly fine. If you're just starting out, most of you should not be trading. Your risk per trade should not be more than 2% of your account, in my opinion. Especially if you're swing trading, you can make a lot more money because of the big moves that you experience over the course of days, right? Much bigger than day trading. So I'm going to go out on a limb and saying most of you that are watching this probably size too big too frequently. And that's why you panic when, as I told you before, you're dealing with daily candles. These are daily candles, right? It takes days, just like when you're looking at a 5-minute candle, at a 5-minute chart, it takes multiple 5-minute candles for price to move up. It's going to expect the exact same thing, but on the course of days. So if you can't withstand a 20% drop in your option and you're shitting your pants, it's because of your size, right? Okay, we're going to talk about psychology and stuff in a second, but hear me out here. Position size matter-of-factly dictates your emotions, not the trade itself. It's your position size. I'll give you an example, okay? Imagine that I told you you have to walk on a sidewalk-sized plank, right? I lay out a wooden plank that's the width is the size of a sidewalk, and I say don't go off the edge, right? And you're at ground level, right? And you're walking, and I say make sure that you don't go off the edge, stay on the plank, right? And I gave you $1,000 if you did that successfully. Would you take it? Right? Would you make $1,000 bet with me that you can walk on a sidewalk wide plank without going off the edges? Yes, of course you can. Imagine I said, take the same bet, but put that plank 10,000 feet in the air. No net, no parachute, right? And now you have to walk, same width. It's a sidewalk. It's a sidewalk width, same width. But now you're 10,000 feet in the air, and you have to walk on that without falling and dying. Would you do that for $1,000? No, you wouldn't. It's the same freaking sidewalk, right? Nothing's changed. It's just that the stakes are higher. So in this case, it's the same thing. If I'm looking at this trade and I'm in it for 2% risk, Nvidia goes up, goes down, I'm down 20%, 25, 30%. And I'm like, okay, the trade still looks good. Yeah, I'm going to stay in it. But if I'm in it for 20% of my account and Nvidia starts dropping, I'm like, oh shit, is this still good? Is this trade still good? Let me hit up Z and ask him, should I sell my options? What should I do here? Oh my God, I'm an idiot. Same exact trade. You just shot yourself in the foot because instead of walking on the sidewalk, you're now walking on a plank that's 10,000 feet in the air. That's it. It's the same exact trade. Nothing has changed, right? So make sure that your risk size is manageable to where you're not freaking out. The problem is that fear and greed go hand in hand. And so when you are not fearful, you enter that position with larger size because you want to make a large gain. But then when that goes against you, your greed literally turns into fear. No, your goal is to consistently make money, and it will compound over time, right? As Einstein said, compounding is the eighth wonder of the world. So the 2% rule means that, in order to take a $200 trade, $200 risk, your account size better be $10,000. You are not going to turn 1,000 to 1,000,000. Okay. There's no point in trading that. You are probably much better going the funded route and learning to trade futures if you want to put up a small capital investment. And we'll talk about that tomorrow because there is a path for you while you build up your account by working, or if you have a business or whatever, build up your account to where it's at the point where you are ready to trade options seriously. Now, the big difference between position size and risk size People mix these up a lot, okay? So say that I want to risk $2,000 on a trade. This is not your position size, meaning I'm not buying options for $2,000. My position size is actually bigger than this, right? My position size could be $10,000. And you're like, what? Wait a minute. I thought you said the 2% rule. Yes. Position size, risk size. This is how you make money in the markets, okay? If, say that this, let's just take this exact trade. If I calculated that if my stop hits, right, that's roughly going to be minus 20% of the option, right? If my stop hits, I calculate, and I'll show you how to calculate that. But let's say my stop hits, it's going to be 20% loss, right? That literally, if I want to risk $2,000, that means that my position size can be 10,000 because I'm not. The problem is most noobs, whatever amount of money that they buy with no matter the amount of money that they spend on options, they're expecting it to go to zero, right? This is how most people trade. I'm going to buy an option. Oh shit, gone to zero. I'm going to buy an option. I'm going to try this trade. Oh shit, gone to zero, right? They don't understand exiting or risk management or a failed trade or, managing your trade where with no emotion, where if it hits your stop, you're out. That's it. So this is how you make money in the game. It's not that if my risk, my 2% risk is $2,000 and I buy $2,000 worth of options and I just let it go to zero. If it goes against me, right? If that trade actually works out and it hits my target, yeah, sure, I made money. But imagine taking a $10,000 position size to target versus a $2,000 position size, right? So if I enter here with $10,000 as my position size, if my stop limit hits, I'm down my risk amount. I'm down 2,000 and I close my position. This way, if my target hits, I'm entering with my desired position size, not my desired risk size. This is something that evades so many people, right? They're like, my risk is 2,000, so I'm going to enter calls with 2,000. Okay. Oh shit, it's going against me. Oh shit. Okay, I guess it's zero now. Well, I tried. No. Position size is what you enter with. Risk size is how much you're risking if your stop limit hits. Hopefully that makes sense. I know some of you know this. I know a lot of you are like, oh my God, what a light bulb moment. I never thought about it like that. Yes, because you want to take a healthy position size to TP. You want to take it to Valhalla. Stop losses and profit targets. Okay, let's talk about this. It's not as exact as stocks or futures, as I said. When I'm buying an option, right, depending on the strike price and expiration, if it expands to near the TP really quickly, you're going to see some of these Greeks accelerate, right? So if it expands quickly, likely IV goes up. delta goes up, gamma goes up, right? And it goes up at an accelerated pace. If price, say price comes up and then say it starts retracing and then goes back up again, this initial push, there's a lot of premium acceleration from the initial push, right? And all of the waves of buyers that are piling in to take advantage of that. That when you get a drawback and then a push back, just because you're at the same stock price doesn't mean that these options are the same way. The initial push is likely going to give you the biggest premium acceleration, right? Now, if you get a push and then a retracement and say that it keeps pushing up, yes, you're going to make more money as the price keeps going up. But I'm just talking about at the same level. This initial push is not going to be worth as much as this one. For one, this timing happens later after this one. And the more time that passes, the more that the option will lose because of theta, right? And two, the initial IV will be likely higher on the initial push than on the second one. So it's not an exact dollar amount when you are doing your risk to reward ratio on your options. Now, I still would like to set up a 2-to-1 at least risk to reward of where I'm entering, right? And it has to make sense based on the chart. So if I'm looking at this and my entry is here and say that my take profit are these equal highs here, and my stop limit is going to be the most recent low, right? If I look here, it's still 2-to-1. But again, it's not exact because options are going to be sensitive to time, sensitive to IV, sensitive to supply and demand, sensitive to a lot of things. But you do have a general idea of how much you're going to make depending on when the stock gets there, right? So, and I'm going to show you a really simple trick, but let's look at NVIDIA here. It's trading at 188. Say I want to trade it to 210, okay? Let's simulate a real scenario here. I'm going to go December 19th. Remember, monthly options are going to be your best bet because they have the most liquidity. Whoops. Whoopity. In terms of strike price, it's going to be a trade-off between the cost of the option and how far out of the money it is, as well as the open interest or the amount of volume that option, not volume, but open interest, which is how many open contracts there are, right? I'm using volume in the colloquial sense. So in this case, I could go 190. I could go 195. Doesn't matter for this example, right? Let's say that I go 195, December 19th. Here's the quickest explanation of Greeks that you've ever heard, okay? And I'm only interested in teaching you guys this in a practical sense. I don't care that you learn every textbook definition. If you want to nerd out, you have ChatGPT. You can do that on your own time. I want to give you the practical way to look at this stuff so that you can trade. You can get to the charts quickly. When I look at delta, right, this option is going to cost me $1,000, $1,015, assuming the market is open. Has nice open interest, bid ask narrow, nice. We have a good expiration, December 19th. We have time for this to play out. Delta, 0.45. What does this mean? This means that for every $1 move in NVIDIA, right? NVIDIA is currently 188. This option will go up by $45. That's what that means. Okay? So roughly, if NVIDIA rises by $23, not taking into account anything else right now, but if NVIDIA rises to $23, you can multiply that by 45. Now, it's not going to be exact, and I'll tell you why. But roughly 1,035 per contract, okay? It's not going to be exact because Delta is such that as the stock price goes up and this becomes near the money, Delta is also going to go up. So Delta is going to accelerate. So it's not a static $45 for the life of this option, right? As price goes up, this is going to get to 55, then 65, then 70. The closer to the money the option is, the higher Delta gets. So this is just like a basic estimation, a conservative estimate of how much money you're going to make if the stock price gets there. But look at Theta. It loses $15 a day. Right? So depending on how many days it takes to get there, you're going to have to subtract this from this. And Theta is not static either, right? The closer that we get to December 19th, which is the expiration, the quicker Theta decelerates, or Theta accelerates and the options price decelerates. So this is not static either, but it kind of gives you a rough estimate of how much you're going to make. Also lose because, every dollar drop that NVIDIA goes down, your option is going to lose $45 in Delta, in addition to the $15 in Theta every single day. So it gives you a rough estimation. Luckily, there is a site, multiple sites that are free that can actually estimate this for you. So optionsprofitcalculator.com, it takes this calculation into account. What I said, your delta is $45 for every dollar NVIDIA goes up. Theta is losing $15 a day. However, this accelerates as price goes up. This accelerates as time goes by, right? So time and price. And this will take all of that into account for you. So if I go to NVIDIA, let's say current stock price it's actually not that. It's 188.15. And I buy the December 19th 195 call. Let's just go mid price. Let's say I buy one contract. It's going to cost me $1,007. And I go calculate. Pulls up this neat little graph. And you guys should be doing this for all of your swing trades. And it shows you on what date and what price. It shows you how much that option will be worth depending on what date we are in and what price NVIDIA is at. So if NVIDIA jumps up to 205, the next day, you'll make $967. You can see it up here, $967. Same video drops, right? Let's see what our stop limit is. Our stop limit is 176, okay? Why can't I change this? Let's say NVIDIA drops to like 175, right? Let's say it does that in, I don't know, 4 days. This option that cost us $1,000 is now down $611, 60%. Okay. And this is what I'm saying when people do not know, they don't even have a sense for how much an option can be down. So this option is down $611. So this would come into your calculator. This is why I said here that you're probably sizing too big too frequently. People will buy multiple of those calls and hope for the best, not knowing that you could be down 60% within a few days, right? So if you're down $600 per contract and you bought multiple, right? And say that your risk size is only $600, but say that you bought 5 calls. Well, now you're down 3,000 as opposed to what you initially intended as your risk size, which in this case, say was 600. So that's how you know that you should buy 1 call of NVIDIA if your risk size is 600. Say your risk size is 1,200, then you should buy 2 calls, right? Remember, your goal is not to buy it and let it go to zero. Your goal is to put up a decent position size where your risk, if your stop limit hits, matches what your risk size is per trade, which should be based off of, in my opinion, in the beginning, the 2% rule. As you get really good, you can go 10, 15, whatever, depending on your conviction. So that is the difference between risk size and position size. And that's how you calculate your take profit and stop limit for options. Remember that optionsprofitcalculator.com is this site here. It's free. It's amazing. Futures and stocks are a lot easier because, like I said, the dollar amount is fixed. If I'm buying ES futures and I go from here to here, I know exactly how much I'm going to make. If I go from here to here, I know exactly how much I'm going to lose. And it never changes. It's absolute. All right. We talked about premium expansion as well. We just talked about delta and theta. Inflated premiums and the problem with chasing. Oh, and I did go over this as well when we talked about AMD as an example, right? If you're looking, if you buy the chase, the premiums are inflated, and on just a tiny retracement, this stock can be down 60, 70, 80% unintended, as opposed to waiting for the breakout and retest. So we talked about that as well. I will get into psychology and discipline. I'm wondering if I should open up the chat to Q&A here. I will after this, okay? So managing emotions during a trade. As I said, a lot of what you deal with is based on your position size. Remember that analogy of the plank, the sidewalk-sized plank, being on the ground versus being 10,000 feet in the air. It's the same exact exercise. It's just a much higher risk. When it's 10,000 feet in the air, you're now dealing with the fear of height, the possibility of falling and dying. But it's the same exact exercise. You're walking along the sidewalk, which everyone can do with ease. It's not going to be easy if it's 10,000 feet in the air. Um, so position size is going to fix a lot of your emotions. Trust me. Also, being able to see the fruits of your labor, right? If you do all of the proper things up front and your account is now starting to grow, that is going to reinforce good habits, and it is going to help you. The compounded good exercises, it's going to help you manage your emotions down the line, right? If you're dealing with managing emotions now, one, it's because you're not very sure if you're doing what you're supposed to be doing. So if you outline exactly what you're supposed to be doing with regards to, this is what I'm looking for in a trade, if you can explain it as a thesis, if you can write down why you're taking the trade, right? So an exercise would be, have a notebook right next to you, or you could type it in your notes or whatever. But if you can explain, hey, okay, we have this level here, we broke out of it and are retesting it. I also recognize that this sector is in a very strong momentum right now. And I'm going to buy this, and I'm going to set my stop limit at the most recent low. And you can write that out. You've already done most of the work, right? And then if you know exactly how much you're going to lose or make, and you base your position size off of that, then there are no surprises, right? As Kobe said, he didn't get rattled during the game because he's done it 1,000 times in practice. A lot of you are not doing that. You're opening your brokerage accounts, you're hoping for the best, and you're placing bets, and that's all you're doing. You're not putting in any of this work. And if you don't do that, you will not have any control over your emotions, because everything that's happening is unexpected, right? Understanding the actuality of swing trading timing. Like I said, these are daily candles. They're not 5-minute candles. If you are used to looking at 5-minute candles, you really have to make a conscious transition to the daily time frame and say, man, if I'm looking at 5-minute candles and I'm watching it, I'm watching each candle, I'm watching it move. If it takes this long, this many 5-minute candles to make a move, how many days is that? So you cannot, a position being down or not moving in your favor yet, this is all stuff that you created in your mind. You have to give the position time to play out. If your stop limit hits, it hits. That doesn't matter. That's what's saving you. But limiting unexpectedness is key. And no matter if you're swing trading, day trading, the more that you are surprised, the more wrong you are doing. You shouldn't be surprised at all, like at all. The only surprise that you should that should arise is a good surprise, right? Like when I entered this swing trade on AMD, the very next day they announced an OpenAI partnership. So I still expected the stock to move up. I didn't expect up, 24% in one night. That surprised me. But in general, aside from anomalous news, nothing about your trade should surprise you. Not the amount of money you make, lose, your stop limit being hit, the drawdown amount. None of it should be surprising. If it's surprising, you're still doing things wrong. Everything, all of it should be expected. And fear and greed will ruin you. As I said, like, you manage your risk up front. What happens is you enter a trade out of greed, and then you react out of fear. You should be entering a trade off of objectivity and reacting off of objectivity. That's it. Let me open up the Chitty chat. God help me here. Hopefully I don't regret doing this. Oh, one thing I will say. We are going to be doing futures. Again, absolutely free. We're going to be doing futures day trading tomorrow. futures day trading, and it will also include it will also include it will also apply to options day trading as well, right? But we are doing the mastermind in January. A whole new season of mastermind starts in January. It's going to be 4 weeks, 8 classes, twice a week. This is, we really have dialed it back to doing it 1 to 2 times a year now, and it's something that everybody waits for. So whether you're in the Discord or not, I'm going to give everybody the same early Black Friday price. The price has gone up to $2,500, but you will get emailed the coupon code and an application. So you will get emailed an application. If you're accepted, then you will get the coupon code for the early Black Friday deal. And yeah, if you're not in the Discord, you will get access to the Discord as well for up until the mastermind is concluded in February. So you'll just get access to the Discord. You get to trade with me live every day as well. So that's included if you're not part of the Discord already. All right. Let's get through your questions. First of all, was this helpful? If this was helpful, let me know in the chat. If this was helpful, put a 1 in the chat. And then I'll answer your questions. One of the best sessions I've attended. Oh, appreciate it, bro. Okay, I'm glad it was helpful. Can you review the UNH trade you spotted earlier? Sure. Later. Swing trading is easier than day trading? Yes, absolutely. Do you have a video placing a trade with TradingView? You can't do that with options. Tomorrow, when we talk about futures, we'll go over how to place trades in TradingView, because you can with futures. You can't do that with options. Earlier you mentioned how to select stocks for options. Yes, that's a good point. Let's get into that. Give me 1 second. And then I'll get into all your questions. Give me 1 second. Keep writing your questions, but I'll be back in 1 second. Give me time. All right. We back. I'm going to put the application for the mastermind here too. 1 second. I'm going to pin the mastermind application to the chat. So to apply for the mastermind, click that link. And if you're accepted, you'll know. If not, you'll know as well. All right. How to select stocks. I did talk about this. What stocks to trade. So this is actually very easy. The reason is I have a list of stocks here, right? If you look at all my stocks, these are all high volume stocks. As I said, you want to trade stocks that have a lot of volume. So these are going to be stocks that you know very well that have a large amount of volume, right? Meta, Google, Robinhood, Tesla, Nvidia, AMD. Obviously the momentum names now, right? Like Iron, CoreWeave, MicroStrategy. These have high, so you want to start there. Secondly, you can look at volume in TradingView. This is why I love TradingView, and I'm going to send you guys a discount to TradingView if you don't have it already in the follow-up email. But you can sort by average volume per day, right? And this is how I found something obscure like Path. But if you sort by volume, and if you're in the Discord, ask me for my settings and I'll send you these settings. Or you could take a screenshot and copy them, because it's not just volume. I'm also looking at, in general, larger market cap, at least 300 million market cap stocks. I don't want to look for like tiny penny stocks. But you could see that the average volume that these stocks currently trade at. Sorry, the volume that these stocks currently trade at for the day, right? Not the average volume. This is the volume for the day. So you can see that Intel, right? Large amount of volume. Ford, Snap, American Airlines, Rivian. There are some stocks I wouldn't look at. Like I wouldn't look at Rivian on a daily basis. But now I might see that and I might say, okay, I have my list of stocks, which are basically the popular names. What the fuck is this? And I might look at Rivian and be like, I wonder if there is something that I can exploit here, right? Again, I'm just looking for really one of these. Where is it? One of these things, right? Support turn resistance, change in a long-term trend, high volume on a break and retest, as well as momentum stocks. If I'm looking at this and I can't make sense of it, and I'm looking at Rivian, just because it has a lot of volume and, you know, it did go up one day 23%, but that was because of earnings. So that always happens with earnings. I'm looking at this, there's nothing for me to trade. No. Because my eyes are trained, and like I said, I want you guys to really look at technical analysis as something that's relatively easy. It does not have to be complicated. I'm looking at a trend here. You have a trend line, clearly, right? I've never looked at this stock, at least recently. You have a trend line there. You have a trend line here. Rivian is coiling. I'm not interested in it currently. Now, if you wanted to say, I'm going to short this trend line and I'm going to set my stop limit, you know, here or whatever. I don't mind that trade. Not my type of trading. But as long as your risk is managed, I don't have a problem with it. Okay? There isn't a perfect way to skin a cat. Multiple ways. Actually, I've always hated that metaphor. It sounds kind of gruesome. There aren't a lot of ways to bake cake. I mean, there are a lot of ways to bake a cake. Okay? Let's just say that. So I particularly don't like that type of trading. You can if you wanted to, as long as your risk is managed. For me, I would much rather see something like this. Break and a retest, right? Before getting in this. But just a quick exercise of, I have my list of stocks, the main ones that have a lot of volume every single day. I have my list of stocks that are in currently hot sectors, which is AI. And then there are things that I might not be aware of, right? Like EOS, right? I think this is an energy company or electric company, energy company. Currently in a hot sector, energy, especially energy related to AI data centers, right? And I might look for a particular trade here. Now, again, I don't really like to react off of earnings because earnings are an anomaly, and this just had earnings, which is why it went up 20%. But let's just say, leaving that aside, right? We had an obvious bull flag here. Remember, everything that you do is support and resistance. And it breaks out. Say it retests this level. Yeah, I might take a trade. I would set up a trade here, stop at the last low. Do we have a target? Yes. There's a precedence for this. There's actually twice it hit this high. That's clearly a level. I might take a trade like this if we get a retest, right? I'm not a breakout trader. Like I said, I've already outlined why breakout trading for options can be dangerous. If I bought this breakout with IV and delta spiking and we retrace, that retrace could cost you 60% already. You don't want to do that. If you're trading stocks, less of a problem. Leverage, it's a problem. Could be a problem. So that's how I find stocks to trade, right? The regular high volume leaders, hot sectors, and then things that have a lot of volume that might not be on my radar. Moral of the story, you don't want to trade things that don't have volume. Oh, a lot of questions. Appreciate you guys, and I'm glad you find this helpful. Yes, you have to set for most brokers, you have to set your stop limit and TP manually. Someone was asking if it can be done automatically. In something that's advanced like Thinkorswim, you can set conditional orders. You cannot do that in Robinhood or any of these other platforms. You might be able to do it in Fidelity or Interactive Brokers, but I can set a stop limit to exit that option based on the stock price in Thinkorswim. Most other brokers you can't, and you will have to do it manually. I'm looking at the monthly subscription to dip the toe. How would it align with my process? With all due respect, Lily, I don't know who you are and what your process is. How do I know if it will align with your process? I have no idea what your process is. What time is the futures class tomorrow? Same time, 11 a.m. If the trade went against you, how would you decide whether to close, roll it, or let it run? Based on the chart. Based on the chart, the reason that it dropped in general, you do want to manage your risk according to what you initially set out. So if you're looking for a very general answer, yeah, you want to get out of that. If you're looking for a more nuanced answer, the better you get at reading why that happened, whether it's just a morning sweep of liquidity and we'll come back up. That takes a lot of practice, right? And we'll talk about liquidity tomorrow when we get into day trading. Is it best to trade one stock at a time for options? If you're asking, then you're likely a beginner, and I would say yes. If you're not a beginner, then no, you can have multiple setups. If Nvidia's at 188 now, why don't we buy it in stock at cheaper price? Because of what I talked about earlier. No one said you can't buy the stock, but you have more leverage with the options. So buying 100 shares of Nvidia costs $18,000. Buying an option costs a tenth of that. Can we discuss UNH? Not if you ask me like that, no. This is a trading seminar, so we're going to stick to trading. Are you putting a stop loss equally with recent lows or just below it? This is a good question. So in general, I'm putting it at the recent low, right? But pay attention to your risk to reward. So let's just stick to this stock here, EOS. If I was trading this and my target is here, if I'm putting my stop here, my risk to reward is still pretty healthy. I could see this protruding low here. If I put my stop here, my risk to reward is still healthy. So it's a trade-off as well between where that where you can place your stop at the recent low and give yourself room, and whether your risk to reward is still in line. So if I put my stop here, sure, that's a tight stop. I could put it here and I'd still be okay. Now, say that my target was here, right? I'm not taking this low as a stop because now my risk to reward is lopsided. So I would have to move it up in order to maintain a better risk to reward. So it's a trade-off, right? It's not an exact robotic scenario. How quickly can you tell when a call's options premium is considered too expensive? I don't know what you mean by too expensive. In relation to what? Will you be able to talk about selling cash secure puts today? No. Today's not an option selling seminar. We will get into option selling in the mastermind. Can you explain your packages a bit? If you can't tell, it's literally written on there. Word for word. It couldn't be clearer. Now, I'm not being facetious. If you can't tell, I would say really reconsider whether you want to join or not, because it's as clear as day. Investing, $49 a month. Access to long-term investing ideas, regular stock market updates, long-term stock buys, monthly investing calls. Does not include swings, day trades, or market open live streams. Couldn't be clearer. Here you get access to all of this stuff and access to the swing trades, the day trades, the live trading sessions. Don't know how to make it clearer, my friend. How to select options with a small account? You don't. You grow your account to a bigger one, or you paper trade until you grow your account to a bigger one. I'm not going to sell you a dream and say, here's how you turn 500 to a million. Not going to happen. And anyone trying to sell you that is just trying to take your money. I promise you that. Okay? I'm not a bullshit artist. I will tell you this up front. I promise you they just want your money. You will not grow your small account to a large account. Can it happen if you get lucky? Yes. Will you most likely lose your money trying? Yes. I appreciate you guys commenting on how helpful this was. Please talk about cover calls. No, this is not an option selling webinar. How long did it take to build a healthy habits? I talked about this several times, but it took me almost 3 years to get to a point where I'm breaking even, to be a break-even trader, okay? Where I'm not making stupid mistakes. I'm not really making money. I'm not losing money. My balance isn't moving. I'm winning some, I'm losing some. At the end of the year, I'm roughly break even, okay? That took 3 years to get to a break-even trader. It took another 2 years after that to become a profitable trader, not making enough to quit my job, right? Granted, I was getting paid quite a lot, so there's that. But another 2 years to be profitable, and then another couple years to make a considerable amount of money where now I'm competing with my job salary. I was also self-taught, and we didn't have all the resources back then that we have now, right? There are tons of resources online, including the one that you're watching now. So full disclosure, that's how long it took me. Regardless, if you want to be able to click buttons and make money, it's going to come at a cost, and that cost is effort. How would you decide whether to roll or close? I just talked about that. I've learned more in this webinar than any paid subscription. Bro, that means the world, man. Thank you so much. Can this video be replayed after the stream is done? If you guys watch this, then yes. For those that couldn't join, then no. Is stock like MicroStrategy great for options trading? I don't know if it's great. Any stock that has volume can be considered good for options trading if you are managing your risk and you are entering based on a criteria. Can you provide some books to read on psychology? The Best Loser Wins. Greatest book of all time. What time in the morning do you trade? When the market opens, bro. How did you trade while having a full-time job? Because I live in California, and that's a very, very, very big advantage. If you live on the East Coast, it's a big disadvantage. If you live in Europe, you could swing it. Asia, you'd have to be up all night. But the market opens here in the West Coast at 6:30 a.m. So I didn't start work until 9:30, 10. By the time my work started, it was already lunchtime in New York, right? And I just traded the AM session for most of my learning years. I didn't trade the PM session, although there are times, admittedly, I would trade from my desk too at work. But I learned to just stick to the AM session, and I had the advantage of being here. Does the next mastermind cover option trading? Yes. Would you consider NVDL? This is not the forum for that, bro. Do you use trendline retests also, or always level retests? Answered on the call already. Yes. Trendline retests count. How do you identify areas of liquidity? By looking at the chart. By looking at the chart, my friend. Every support and resistance line is an area of liquidity. That's why break and retest works. It's breaking and retesting former areas of liquidity. Right? Final area of liquidity here on AMD taken. Also, as we went over on the call, a huge area where orders were. Obviously, we can't get into every single thing, but there are a lot of things. There are a couple of things that you can use for confluence, like the Fibonacci, right? Like, why did United Healthcare stop there? If you take a fib from that low to that high, you have what's called the optimal zone where we bounce from. If you look at UNH now on the weekly, on the daily, it's like, kind of looks strange. But where's this level here? Look at that. We have that. On the weekly, which we will be discussing tomorrow, but there's a weekly fair value gap along with this level. And I bet you if you pull up a fib, we are near 50% of this entire move. I like this trade on UNH. Now, UNH might not move for a while. So if I do take a trade like this, I would likely have to buy 2 months out. December 19th is writing. So if I entered a trade like this, right? And I set my stop on this previous low, my risk to reward is about 2 to 1. Right now it's November 8th. December 19th is like a month and a half. I could take December 19th. I would go, as we just talked about, let's look at open interest. We have good open interest here. We're currently trading at 324. December 19th, 330 is one strike out of the money. Bid ask is not accurate when the market is closed. Kind of not a great bid ask, not terrible. It's 75 cents. Obviously depends on where it's at when the market opens. Yeah, the bid ask, not great. But again, the market is not open. So assuming that by the time Monday rolls around, I will hopefully see better bid ask on these. If not, then you obviously want to get filled closer to the bid than the ask because it's cheaper. You want the cheaper price, right? But you likely won't get filled at the bid. Might be 5 or 10 cents more than that, but you still want to set a limit order at the bid. And I could go, I wouldn't go more than 2 strikes out of the money, only because we might not see a move like this on UNH. So you also have to factor that in based on the character of the stock. So I would go either at the money or a couple strikes out of the money, not more than that, and go December 19th and say by November 19th, if we don't get movement, and my stop hasn't hit, then I will likely roll it to January. So that's how that exercise will go. Volume is how much volume was done that day. Open interest is how many contracts are open. How does a year-end loss factor into a swing to year-end? No idea what you're trying to say, bro. How do you swing trade put options? Exact same way. Any future plans for lifetime? No. No. We may give a couple out as prizes or something, but no. All right, guys. Appreciate you. Like I said, you will be sent an app. Well, actually, you can click on the application in the pinned comment in the chat in YouTube. But you also will be sent application. If you are accepted, you will get a promo code for the next mastermind, which will also give you access to the Discord up until, if you get it now, up until February. So you're basically getting until the end of the year to trade with me live every day, in addition to the mastermind. But I appreciate y'all. I'll see you tomorrow for the day trading and futures, which is going to be an entirely different seminar to this one. And for those that are asking about small accounts, futures really is the way to go, because you could trade prop firms and have the chance to make a shit ton of money with a limited amount of capital. I do not advise or suggest trading options with a small account. I just don't. All right, guys. I'll see you tomorrow. Thank you for hanging with your boy. Have a great rest of your Saturday. Peace.